factors.
Okay, well, Andrew Holland is with us, Chief Executive Officer at Avendus Alternate Strategies. Andrew, good morning. Good to have you with us here. Thank you for your time. Newer segments, I think, right? Because, I mean, if you think about it, some of the conventional sectors, so as to speak, growth rates have slowed down. Earnings growth, etc., has slowed down, and it's non-trivial, right? The pace at which earnings growth has come off for the large conventional sectors. Now, you can spot a banking there and say, well, maybe things are looking better. So let's talk non-conventional in that sense, non-traditional. Solar, for example, is one. These are newer industries where there is opportunity. But again, valuations are a bit of a problem. Your thoughts, Andrew, for some of these newer non-traditional areas, and what's the top idea, top theme?
You know, that's a difficult one, Prashant, is that, wherever you look, there's a valuation problem. It could be because it's getting earnings downgrades, and therefore, some of those traditional sectors you're talking about are being hurt because of that, because the top line and margins are under severe pressure. And some of the kind of new age technology stocks and new kind of areas are seeing that, that's where the growth is. But the valuations are also quite rich. So you're kind of caught between, looking for value in the traditional sectors, but knowing that the downgrades are coming, and not really wanting to kind of pay up for some of the high growth areas. The areas that we talked about, the themes we talked about before, was obviously electronic manufacturing. And I think that's a great one. I would pay up for these companies, because I think there's a 3 to 5 year runway of which they could make huge amounts of top line and bottom line profitability. So that's one area I would continue to look at. But with solar, the prices are coming down. I'm just not sure that it's an area that I get more excited about. I can see it in the electronic manufacturing sector, but I'm just not so keen on the kind of solar part of the business in terms of the pricing pressures I expect will happen going forward.
Like the electronics manufacturers more than the rush for renewables, perhaps. Andrew, good to have you on the show today. So I think a slightly broader question. The market here has had a good run, but now as we enter the new year, the question is what will take it higher? Which is the sector that can have leadership? Can FMCGs be in the doldrums? Can banks take on that mantle? Will it continue to be some of these capex and manufacturing related stocks? What's your sense? So
my feeling is that I think, the market is hoping for this extra kind of Santa Claus rally. FIIs will kind of, pack up and go off on their holidays soon. And therefore, the tendency is, don't sell in this month because you usually get a reasonable return. And then, of course, going into January, you will have all the kind of expectations for the budget. Notwithstanding that, obviously, President-elect Trump will obviously take in administration at that time as well. So I think volatility is going to be a little bit more in January. But what I would say is that I don't think the banking sector, as much as I've been a bull on it, can really take the mantle at the moment. The GDP growth is way below expectations. And I know that the forecast is for around 6.8%, but I think it's going to be near to 6%. So there's a lot of pain to come yet. So I would hope that the government starts spending. So I would probably go for the capital goods. I'd probably look at that sector as being where you can see at least some contracts being awarded. Doesn't necessarily mean that it's going to hit the bottom line, but usually share prices move in this sector when they get awarded contracts. So if I was thinking of any one sector to lead, it would be capital goods.
All right. Hi, Andrew. Good morning and good to see you. I recall you were hinting that maybe the FI selling will cool off in December. We'll have a better end to the year the last time we spoke. So that seems to be the case, at least as of now. They've returned back to the Indian markets. At least they're not selling. But a couple of themes that you've been very bullish on. And two come to mind, particularly since we're in this seasonally strong period for them. Aviation as well as hotels. What are the stocks you play out there? Because in aviation, you have two of them. One is the leader and one is the one that's struggling for survival. But there could be something on the plate because if the industry does well. So would you stick to the leader? Or would you look at the second player? And also in the hotel industry, Indian hotels out of nowhere, I think in the last 45 days, the stock is up 15% or thereabouts. Your view?
Yeah, well, there's I mean, obviously, I would play the leader in the airline space because I think that's where I think the more kind of revenue and bottom line profitability is going to come over the next 1 year. So I think that's an easy call to make, and also I think fuel prices will come down as well. So I think that would be an extra kind of tailwind. Sorry for the pun, tailwind for the airline industry as well. In terms of hotels, I mean, you know as well as I do, just getting a room anywhere. I was seeing some prices for Goa for Christmas, and they're just unbelievably high. So the hotel industry, and I think there's a few IPOs coming as well. So I think the theme in terms of experiences and travel is not going away. And I think one of the things that gives me even more kind of positivity on the sector is that foreign tourists have really still got to pick up. So if that was to be the case, then this would obviously be an extra kind of revenue line for all the hotel companies across India. So I think that's one extra boost. I don't think the market's kind of penciling in to their earnings forecast, but I think that's coming as well.
The thing is that when 1.3 billion or nearly 1.3 billion people start consuming or investing in stocks, we tend to be pretty much enough for ourselves, right? Whether it's inbound tourism or whether it is just investing in the market, right? It's been the story of Indians doing what they do for India. But so you mentioned that capital goods could be a sector to look at. But Andrew, again, going back to the bigger projection for 2025, are you expecting it to be a more range-bound year for the market because of the growth concerns that you mentioned? And just, walk us through what would your top bets be? What would you strictly avoid? Because there's still a, big debate out there on urban slowdown, perhaps FMCGs not really moving higher, so on and so forth.
Yeah, it's a tricky one actually, because if I just think about India from where we are, then obviously I am expecting the economy to slow quite quickly. Obviously, we could see interest rates fall as well, which would be good for the banks at some point of time in 2025. But the one thing that's holding me back from saying which sectors and which companies are going to do well is obviously what's going to happen when President-elect Trump comes in. And I think that's we're all saying one narrative at the moment. It's going to be higher tariffs, lower tax rates. Lower tax rates in the US could also mean lower tax rates in Europe as well. So this means that flows will not necessarily come to emerging markets. So I think it's going to be not an index play. I think it's going to be individual themes, which we talked on a few of them, which will continue to play out, because I don't see earnings growing more than 10% next year. And if it's 10%, then that's the kind of return you would expect for the market. So it's not going to be a bumper year in terms of the markets, and that's the best case scenario.
Got it. Okay. All right, Andrew. Appreciate you joining in. Thanks a lot for giving us your thoughts. Wishing you a good day ahead.